How to buy stocks instantly. Before discussing the use of hedging to offset risk, we need to understand the role and the purpose of hedging. The history of modern futures trading began in Chicago in the early 1800s. Chicago is located at the base of the Great Lakes, close to the farmlands and cattle country of the U.S. Midwest, making it a natural center for transportation, distribution, and trading of agricultural produce. Gluts and shortages of these products caused chaotic fluctuations in price. This led to the development of a market enabling grain merchants, processors, and agriculture companies to trade in contracts to insulate them from the risk of adverse price change and enable them to hedge. The first commodity exchange was the creation of the Chicago Board of Trade (CBOT) in 1848. Since then, modern derivative products have grown to include more than the agricultural industry. Products also include stock indices, interest rates, currency, precious metals, oil and gas, steel, and a host of others. These origins of the commodity and futures exchange was created to support hedging. The role of speculators is beneficial as they add trading volume and important volatility to what would otherwise be a small and liquid marketplace. A bona fide hedger is someone with an actual product to buy or sell. The hedger establishes an offsetting position on the futures or commodity exchange, thereby instituting a set price for his product. Someone buying a hedge is known as being long or taking delivery. Someone selling a hedge is known as being short or making delivery. These positions, known as contracts, are legally binding and enforced by the exchange. Entering your trades either for speculation or hedging is done through your broker or commodity trading advisor. Commodity and futures exchanges are distinct from stock exchanges, although they operate using the same principles. They are regulated by different agencies such as the Commodity Futures Trading Commission, who are responsible for regulation of retail brokers in the USA, as well as commodity trading advisors, who are portfolio managers. The manager thinks of his options. The greatest risk is to do nothing. If the market falls as expected, he risks giving up all recent gains. If he sells his portfolio early, he also risks being wrong and missing further rallies. Selling also incurs substantial brokerage fees, with additional fees to buy back again later. Then he realizes a hedge is the best option to mitigate his short-term risk. He begins by calling his CTA and, after consultation, places an order to sell short the equivalent of $10 million of the S&P 500 index on the Chicago Mercantile Exchange (CME). Now his result is, when the market falls as expected, he will offset any losses in the portfolio with gains from the index hedge. Should the earnings report be better than expected and his portfolio continues upward, he will continue making profits. 2 weeks later, the fund manager again calls his CTA and closes the hedge by buying back the equivalent number of contracts on the CME. Regardless of the resulting market events, the mutual fund manager was protected during the period of short-term volatility. There was no risk to the portfolio. ABC telephones their CTA and, after consultation, places an order for 2 hedges, both for an expiry in 8 months, the date of delivery. Hedge 1 is to buy long $5 million of copper, effectively locking in today's price against further price increases. ABC has now eliminated all price risk. The risk of plant closures is greater than the lure of increased profit should copper price fall. After all, ABC is not in the business of speculating on copper prices. Hedge 2 is to sell short the equivalent of euro currency versus US dollars. Since ABC is effectively accepting EC in payment, a rising US dollar and a weak EC would be detrimental and erode profits further. The result of the hedge is no risk and no surprises to ABC in either copper or currency levels. A risk-free transaction and full transparency is the result. In 8 months, with the order completed and the customer accepting delivery, ABC notifies the CTA to close the hedge by selling the copper and buying back the euro currency contacts. Many examples exist to demonstrate the mitigation of risk to an institution or financial portfolio. New products are constantly created and available on both over-the-counter and exchange-traded markets. It would be wise to consult with a qualified commodity trading advisor or broker to discuss the analysis for an ongoing risk management solution or one-time only hedge.